Hey guys, this is Nick Does DJI and welcome to my channel. In this video, I go over the top 3 Vanguard ETFs to buy and hold in 2021. As we wind down this crazy year, investors are already turning to 2021 with the hopes of beating the market. But for many beginning to get into the stock market, numerous investing strategies can often appear intimidating and daunting. You have day trading, option trading, swing trading, dividend investing, dividend growth investing, and so forth. Oftentimes, beginners may experience analysis paralysis and end up never investing in the first place. But with ETFs, I believe that this is a perfectly acceptable investing strategy for investors of any experience levels. Fortunately, Vanguard offers a ton of investment vehicles such as ETFs, allowing investors to invest in the stock market without subjecting yourself to the risk of investing in individual stocks. Vanguard was founded in 1975 by Jack Bogle and has grown to be one of the world's largest investment companies with over $6.2 trillion in global assets under management. Note, I am not sponsored by Vanguard in any way. I just really like their ETF offerings compared to the competition and what they have contributed to the investment community the past couple of decades. Before we take a look at the 3 selected Vanguard ETFs, I just want to quickly cover the basics. An exchange-traded fund, ETF, is a type of investment fund akin to a basket of securities without actually buying the underlying individual securities. Those underlying securities may be stocks, bonds, currencies, and/or commodities. ETFs are publicly traded securities listed on major stock exchanges and can be bought and sold at current market prices like stocks. There are over 2,000 publicly traded ETFs in the United States and over 6,000 globally. Most ETFs are low cost and thus incur low expense ratios because they are passively managed. The average Vanguard expense ratios is less than 0.1% versus 0.5 to over 1% for mutual funds. Most ETFs provide investors diversification. ETFs track an underlying broad index by investing in several dozens to over 500 underlying stocks. Lastly, ETFs are tax efficient. ETFs typically have low turnover on its portfolio securities, generating little to no capital gain taxes. And I just want to make this video fun and reveal 3 different ETFs with 3 different goals, including diversification, growth, and dividend growth. First up on our Vanguard Diversified ETF is ticker symbol VOO. VOO is a large blended ETF investing in stocks in the S&P 500 index, representing 500 of the largest US companies. Its goal is to closely track the S&P 500 index's return, and this is perfectly suited for an investor with a long-term investing horizon. It is currently trading around $335 and has a dividend yield of 1.18%. The expense ratio is only 0.03%, which means that for every $1,000 invested, you only pay 30 cents in expense fees. And personally, 0.03% is the lowest expense ratio that I have ever seen for an ETF. And that's one of the things I really like about Vanguard. In general, they have really low expense ratios compared to other companies. And VOO holds 508 stocks with a median market cap of 143 billion, price to earnings ratio of 25.5 times, and a return on equity of 19.6. The 10 largest holdings only equals 29% of the entire ETF and holds many popular stocks such as Apple, Microsoft, Amazon, Alphabet, and Facebook. And in the past 1 year, VOO returned 0.09%, 5-year average annual return at 14.11%, and a 10-year average annual return at 13.7%. Lastly, a $10,000 investment in 2010 would have grown to $37,574.15 today. Next up on our Vanguard Growth ETF, we have ticker symbol VUG. Whereas VOO tracks the entire S&P 500, VUG seeks to track the performance of only the nation's largest growth stocks. It is in the large growth category, and it currently trades for about $243 with a dividend yield of 0.92%. The expense ratio is slightly higher at 0.04, but it's negligible. VUG only has about half of the number of positions as VOO at 257 stocks with a median market cap of 210 billion, price to earnings at 38.8 times, and a return on equity of 21.1%. Here, the largest 10 holdings equals nearly half of the ETF at 47%, holding many of the same large growth companies as VOO. Here you have Apple, Microsoft, Amazon, Alphabet, and Facebook. But notice here that the top 10 holdings contain a larger percentage of the ETF. So with VUG, Apple has nearly 11% of the ETF, and Microsoft at another 10%. In the past 1 year, VUG has returned 38.22%. Over the 5-year average annual return, 19.24%, and a 10-year annual average return of 16.73%. Lastly, a $10,000 investment in 2010 would have grown to $47,335.29. Notice here how the returns are substantially higher with VUG compared to VOO because you are investing in large cap growth companies. And over the past 10 years, many of the companies here you see today, they are part of the FANG or FANG-M stock that have grown substantially just over the years with the rise of tech, and then especially in 2020 with the pandemic. Last up, for Vanguard Dividend Growth ETF, we have ticker symbol VIG. A stock market video on this channel isn't complete with an ETF that tracks dividend growth paying companies. VIG seeks to track the performance of companies with a record of growing their dividends year over year. It is in the large blend category, and it currently trades for $138.55 with a dividend yield of 1.52%. Notice how VIG's dividend yield is higher than VOO's, which tracks the entire market. The expense ratio is the highest of the three, but it's still really low at 0.06%. VIG has 212 stocks with a median market cap of 137 billion, price to earnings at 25.7 times, and a return on equity of 23.2%. And VIG has a 5-year dividend growth rate of 6.13%, higher than other popular dividend growth ETFs, so that's why I chose this pick. Here, the largest 10 holdings equals about a third of the ETF at 34.7%. And here, instead of the large tech companies, as you saw in the previous two ETFs, here you have companies such as Walmart, you have Microsoft, but then you also have Procter & Gamble, Johnson & Johnson, Home Depot, and other companies where they do have a history of paying out dividends. And in the past 1 year, VIG returned 9.75%, a 5-year average annual return of 14.04%, and a 10-year average annual return of 12.54%. Lastly, a $10,000 investment in 2010 would have grown to $33,959.76. So overall, I would say that VIG is a low-cost and excellent ETF, especially for any dividend growth investors looking to diversify his or her portfolio and want exposure to a collection of dividend growth stocks that have been paying out and growing out their dividend year over year without actually investing in those individual companies. So I hope everyone enjoyed these 3 Vanguard ETF picks, whether you just want general exposure to the S&P 500, or if you want growth or dividend growth, there is an ETF for you. If you enjoyed the content, please smash the like button and consider subscribing to the channel. Please click on the bell notification to receive all the video alerts. Bye.